Silver just crossed the kind of line that changes behavior. And the "it's just a temporary spike" crowd is about to find out how brutal the unwind can get when the curve stops cooperating. Not because silver is mysteriously popular this week, but because the plumbing underneath price discovery is tightening. And once that happens, headlines become background noise and deadlines start setting the price. Look at what the tape has done in January alone. Silver started the month around the low 70s per ounce, roughly $71 and change on January 1st. And within a few weeks, it printed in the mid-90s. Even touching around $94 to $95 in recent sessions. That's not a slow, polite bull market. That's a sudden repricing that turns risk managers into decision machines, and that's where the real pressure starts. Because when a market jumps from about $71 to about $94, you're not talking about a nice percentage gain. You're talking about collateral, margin, dealer hedging, and forced behavior. On a standard COMEX silver futures contract, 5,000 ounces. Every single $1 move is about $5,000. So a $20 move is roughly $100,000 per contract. This month's move is bigger than that. That's the kind of move that doesn't ask shorts how confident they feel. It demands cash. And if cash isn't there, it demands liquidation. But that's not the part that matters. The part that matters is why the move has this particular shape. Quick, violent, and resistant to the usual sell the rip instincts. Everyone's watching the inflation headline and the geopolitical noise, and yes, those are real accelerants. But the hidden mechanism, the thing that makes this breakout feel like it has got teeth, is the time value of silver itself. In other words, the market isn't only saying silver is worth more, it's saying silver is worth more now than later, and that's a completely different kind of message. Here's the tell: the curve, the spreads, the structure. Futures markets aren't just a price, they're a schedule. They tell you what it costs to own something today versus next month versus next quarter. In calm markets, there's usually a clean logic to that schedule. Storage costs, financing costs, insurance, convenience yield. The boring stuff. But when the schedule starts to warp, when nearby contracts get unusually expensive relative to deferred contracts, that is the market confessing that time is scarce. Not silver in the abstract, silver in the window that matters. And when that happens, it triggers behaviors that most investors don't even realize exist. Because in a tight window, the paper market can look deep and liquid right up until participants try to turn paper into metal on a specific timeline. Then you find out what's deliverable, what's theoretically available, what's sitting in the wrong form, and what's already spoken for. That's where the spread starts telling the truth, even if the spot price tries to play innocent. Let me translate that into something you can actually use. The reason silver can gap and lunge isn't because it's emotional. It's because it's a hybrid market, part monetary metal, part industrial input. That means you can get two different classes of buyers hitting at the same time. One buyer class is optional, investors choosing exposure. The other buyer class is non-optional, industrial procurement that has to keep production lines fed. When those two overlap during a macro stress moment, it's like trying to buy concert tickets right as the site slows down. The price doesn't move smoothly. It jumps between pockets of liquidity. And the next detail is what flips the whole setup. Global inflation isn't just a story about prices are higher. It's a story about trust in the purchasing power of cash, about whether bonds compensate you for inflation, about whether currency risk is being repriced. And lately, the inflation conversation hasn't been a clean glide path. Forecasts and official projections can say inflation is moderating, and simultaneously the market can be staring at tariff threats, supply disruptions, and geopolitical chess moves that reintroduce price pressure in bursts. That's exactly the kind of environment where metals go from nice diversifier to the front page of the risk meeting. But if you stop at inflation equals metals, you miss why silver specifically is acting like it's late to an appointment. Silver tends to lag gold until it doesn't. Gold is the reserve asset, the big ship. Silver is the speedboat. Smaller market, more sensitive to marginal flows, more vulnerable to squeezes and air pockets. When silver finally catches a bid, and it's also being pulled by industrial demand, you can get a move that outruns most people's mental models. And if your model is wrong, your decisions get expensive fast. Now, let's talk about the supply side, because this is where a lot of the it'll self-correct logic quietly fails. Most people picture mining like a faucet. Price goes up, miners produce more, supply increases, price comes down. That story is cleaner in textbooks than it is in the real world, especially for silver. A meaningful chunk of silver supply is produced as a byproduct of mining other metals. That means silver output is partly hostage to decisions made for copper, lead, zinc, and gold economics. So when silver price spikes, it doesn't automatically flip a switch on supply. You can't scale byproduct supply in a week. You can't even do it in a quarter in many cases. The market knows this, and that's where the real pressure starts. On top of that, recycling is not infinite and it's not instantaneous. People talk about scrap supply as if old electronics and jewelry magically appear at refiners the moment the chart looks exciting. In reality, recycling responds with lags, bottlenecks, and economics of collection. And refiners themselves have constraints, capacity, input mix, regulatory friction, transport logistics. So if demand surges or supply hiccups, the relief valve isn't as wide as the internet thinks. Now stack that on top of the demand side. Industrial demand for silver isn't one monolithic thing, but it has some powerful anchors. Electronics, power infrastructure, and especially the solar supply chain. The solar sector doesn't buy silver because it likes the macro. More, it buys silver because the engineering requires it, and procurement runs on contracts and schedules. Even if you get some thrift and substitution over time, in the near term, industrial buyers don't have the luxury of waiting for a dip if their calendar says ship product. And this month, the calendar is a catalyst all by itself, because January is not just another month. It's the beginning of the year where positioning resets, risk budgets refresh, and macro narratives reprice. It's also a period where liquidity can be thinner than people expect, especially around weekends, around key data releases, and as we head toward month end. Then add in the futures calendar, rolling positions, delivery windows, options expiry cycles, first notice dynamics. When you compress those timelines in a market that's already tight, the price doesn't drift. It snaps. But that's not the part that matters. The part that matters is what those mechanics force participants to do. A fund short futures might be right on the long-term thesis, but still get forced out because the mark-to-market move is too violent. A commercial hedger might have sold forward production and now has to manage margin calls, even though the physical business is fine. Dealers who sold calls to investors may have to hedge delta by buying futures as price rises, which becomes reflexive. Price goes up, hedging requires buying. Buying pushes price up again. This is how a market turns from trend into event. And we have direct evidence that volatility expectations are elevated. When implied volatility is high, it tells you the options market is pricing in whipsaw. High vol also feeds the reflexivity loop. It changes how much dealers hedge, how quickly they hedge, and how painful gamma becomes around key strikes. If silver is ripping through round numbers like $80, $90, and flirting with $100, you can bet there's a minefield of options positioning and stop orders around those levels. And if one level breaks, the math changes. Now zoom out to the macro layer, because this is where the global inflation pushing prices to new heights line becomes more than a slogan. Inflation isn't uniform. Different regions experience it differently, and that creates arbitrage pressures and capital flows. When investors see policy becoming more politicized, tariffs, trade friction, sudden shifts in alliances, that can reintroduce inflation impulses even if central banks want a neat narrative. It can also weaken confidence in a currency regime, which is gasoline for precious metals. And if the US dollar softens on a sell America impulse, metals can catch an extra tailwind because they're priced globally in dollars. That's the easy part. But that's not the part that matters. The part that matters is how those macro shocks hit a market that already has structural tightness. According to industry research, the silver market has run multiple consecutive years of deficits, meaning demand has exceeded supply on a net basis. Even if the deficit narrows in some years, a deficit is a deficit. It implies you are drawing down inventories or pulling metal out of above-ground stockpiles that may not be easily mobilized. Deficits don't guarantee a straight-line price move, but they create fragility. They create a market that can't absorb sudden bursts of buying without repricing. And that fragility is exactly what a macro shock exploits. So when inflation fears pulse higher, or trade friction ramps up, or geopolitical risk spikes, the marginal buyer shows up. And in silver, the marginal buyer matters more than in most markets. Silver is smaller and its liquidity can thin quickly. A few big decisions, a chunk of ETF demand, a wave of speculative positioning, a procurement panic, a short cover scramble, can push it through levels that would take months in a larger asset. And once that happens, the market doesn't ask permission from the skeptics. It starts forcing them into the trade via pain. Now let S talk about the hidden detail in a way you can actually track without needing a Bloomberg terminal. You don't need perfect data, you need signals. Watch the behavior of nearby versus deferred pricing, how much urgency the market is pricing into near-term delivery. Watch whether rallies are accompanied by spread stress, meaning the market is paying up for immediacy, not just for exposure. Watch whether pullbacks get bought quickly and whether the market can hold above previous breakout zones. Because if the curve is stressed and the market holds new levels, that's not a meme rally, that's a structural message. And you've already seen the speed. Early January, we were in the low 70s. Within days, silver pushed into the mid-70s, then the low 80s, then mid-80s, and suddenly you're printing low 90s. That acceleration matters because it compresses reaction time. In a slow market, Bears can scale out, hedgers can adjust, dealers can rehedge gradually. In a fast market, those same participants are forced to act in chunks, often at the worst possible moment. That is how you get air pockets on the way up and trap doors on the way down. So here's a quick, brutal truth. Even if your thesis is correct, silver can whip you around violently. It can draw down hard, rip higher again, and make you doubt your own eyes. That volatility is not a bug. It's a feature of a thin, levered hybrid market. And that's why you need a two-scenario lens, not a single confident prediction. Scenario 1 is the controlled pullback and retest. Price cools off, volatility stays elevated but stops rising, and silver drifts back toward a breakout zone. Think the high 80s to around $90, then finds bids. Spreads ease a bit but stay firm. The market breathes without breaking. This scenario is how strong trends reset without collapsing. It is also how the market tries to shake out weak hands, a scary dip that feels like it S over, followed by a slow grind back up that makes you regret panic selling. And that's where the real pressure starts. Scenario 2 is the continuation squeeze. The market refuses to give you the clean retest. It keeps pushing through resistance, rips toward the psychological magnet around $100, and does it with gaps, overnight moves, weekend gaps, thin liquidity spikes. In this scenario, dealers are chasing delta, shorts are paying up to buy back risk, and late buyers are getting pulled in by fear of missing the move. This scenario feels unfair because it punishes patience. But it is also the scenario that shows up when the curve is stressed and physical availability is tight in the window that matters. Now, let's talk levels, because levels aren't magic lines. Levels matter only when they force decisions. Right now, the obvious decision levels are the recent highs in the mid-90s, the round number at $100, and the breakout shelf around $90. If silver can hold above roughly $90 on pullbacks, especially if it does so quickly and with buyers showing up before the market can relax into that S-bullish structure, if it loses $90 cleanly and then struggles to reclaim it, you're no longer in a clean breakout environment. You're in a failed breakout risk environment, which is where silver can punish people with a deeper flush. Below that, watch the mid-80s area, because that's where the market recently staged and launched. If silver were to slide back into the mid-80s and hold, that can still be constructive, but it changes the tempo. It says the market needed more cooling. If it slices through the mid-80s without finding buyers, then you start looking toward the low 80s, levels that were pivotal early in the month. And if you're really looking for a cleaner invalidation concept, something that would seriously weaken the breakout moment narrative, it would be a sustained move back into the low to mid-70s, because that would imply the market fully rejected the repricing. Not impossible, but it would require the macro and the curve to meaningfully relax at the same time. Here is the thing. The difference between healthy pullback and thesis break often comes down to the same hidden detail, time. Does the market continue to pay up for immediacy, or does that urgency evaporate? Because if urgency evaporates, the rally can become purely speculative, and speculative rallies are easier to fade. But if urgency persists, if the market keeps pricing near-term scarcity, then dips become buying opportunities for participants who have deadlines, not just opinions. Now let's address the skeptic's best argument, because ignoring it is how you lose trust. The skeptic says, silver is volatile, it overshoots, and industrial demand can soften in a slowdown. That's fair. If global growth wobbles, some industrial demand can cool. Also fair. A sharp rally can invite profit-taking, and higher real yields can be a headwind for non-yielding assets. So yes, there is a clean pathway for this move to stall. But the next detail is what flips the whole setup. Even in a softer growth environment, you can still have inflation impulses, especially if driven by tariffs, energy shocks, or supply disruptions. You can have a world where growth isn't booming, but trust and policy coordination is fraying. That's when precious metals can perform even if the economy looks mixed. And silver, because it is both monetary-ish and industrial, can behave in a way that confuses people who only watch one narrative at a time. If the macro bid shows up at the same time as a procurement baseline, you get a floor. Not a perfect floor, but a floor that makes bearish bets more dangerous. Also, the market isn't purely about end demand, it's about positioning. When a move this size happens quickly, positioning can become the story. Shorts get trapped, not because they were evil, but because their risk limits are mechanical. Margin calls are mechanical. Stop losses are mechanical. Dealer hedging is mechanical. Funds that target volatility are mechanical. Once the move flips enough mechanical switches, you can get a cascade that looks like mania from the outside, but is actually math and rules playing out. This move isn't emotion, it's math. And that's where the real pressure starts. Now, what should you watch right now, today, this week, this month, if you want to stay grounded and not get emotionally hijacked? First, watch whether silver can consolidate without collapsing. A strong market doesn't have to go up every day, but it tends to refuse deep, leisurely drawdowns. When it dips, it finds bids quickly. When it rallies, it doesn't immediately give it all back. That's structural. Second, watch the round numbers and how price behaves around them. $100 is not important because it's mystical. It's important because it concentrates behavior. Option strikes, take profit levels, media attention, and the psychological shift from it due to a rally to it is a phenomenon. If silver tags $100 and snaps back violently, that's not bearish by itself. It could be a pressure release. But if it fails repeatedly at $100 while losing $90 support, that's a warning. Third, watch volatility. High volatility is a double-edged sword. It can fuel squeezes, but it can also be used against you. The market will whip you around, make you doubt, and try to force you into the worst possible timing decisions. The trick is distinguishing trend signal from noise. Trend signal is the market holding higher levels and refusing to break structure. Noise is the intraday chaos designed to shake you. If you can't tell the difference, you become liquidity for someone else. Fourth, watch cross-market tells. Silver doesn't trade in isolation. Watch the dollar's behavior in stress moments. Watch real yield proxies. Watch gold-silver relationships. Not because you need a ratio religion, but because divergences can hint at who is buying and why. If silver is outperforming sharply while the macro is messy, that can be a sign that industrial urgency and positioning are joining forces. If silver is lagging while gold runs, that can be a sign that the bid is more purely reserve asset than hybrid squeeze. Fifth, and this is the big one, watch urgency in the structure. Any sign that near-term demand is pulling metal forward and compressing the time premium. You don't need to be perfect. You just need to notice whether the market is acting like it wants silver now, not later. Because if that urgency persists into month end and into the next set of roll and expiry windows, it can keep the squeeze psychology alive. And if it disappears, it tells you the market is cooling in a meaningful way. Now let's build your psychology shield, because this is where most people lose money even when they're right. Silver will use volatility like a magician uses misdirection. A sharp dip will feel like the thesis died. A sharp rally will feel like you missed it forever. Both feelings are engineered by the market's structure and liquidity, not by your intelligence. If you're finance-minded, the goal isn't to feel nothing. It's to feel the emotion and still follow a process. Here's a simple process that keeps you from getting played. Decide in advance what would actually change your mind. Not, price went down today. Something structural, a break of key support that doesn't recover, a clear relaxation of urgency signals, a macro shift that tightens financial conditions without an offsetting safe haven bid. Then decide what is merely noise. Intraday spikes, social media hype, scary headlines. If you don't predefine that, the market will define it for you in real time, and it will choose the option that hurts you most. Also, respect time horizon. If you're watching this as a macro watcher, your horizon might be weeks to months, not hours. If your horizon is weeks to months, then hourly volatility is mostly a test of your discipline, not a signal about the thesis. If you're a trader with a tighter horizon, fine, but then you must treat levels and volatility regimes with respect. Silver is not a market that forgives sloppy sizing. It will find your leverage and embarrass you with it. Now, why is the why now so important this month? Because the calendar doesn't care about your opinion. Month-end forces funds to rebalance. It forces hedgers to roll. It concentrates liquidity into specific windows. Options, expiry concentrates hedging behavior around strikes. Delivery cycles concentrate attention on what can actually be sourced in time. When those windows line up during a macro stress moment, when tariffs, geopolitics, and inflation concerns are not calm, you get a squeeze-friendly environment. The market becomes hypersensitive to small imbalances. And in silver, small imbalances can look big fast. So here's what comes next. Your near-term roadmap, the checklist that keeps you honest and keeps you from getting hypnotized by the candle colors. Over the next week or two, watch whether silver holds above roughly $90 on dips. Watch whether the mid-90s zone becomes a floor or a ceiling. Watch whether price action around $100 is a clean break, a rejection, or a churn that builds energy. Watch whether pullbacks are shallow and aggressively bought or deep and lazy. If you see a controlled pullback that holds structure, especially if it snaps back quickly and reclaims lost ground, that favors scenario 1, the retest and reload. In that world, volatility stays high but becomes tradable. The trend remains intact, and the market tries to shake you out before continuing. If you see the market refuse pullbacks and keep pushing higher with gaps, that favors scenario 2, continuation squeeze risk. In that world, you need to respect gap risk and the possibility that the market moves when you not looking. You also need to respect that squeezes can reverse violently once the forced buyers have finished, so chasing blindly is how you get punished. The move can be right, and your timing can still be wrong. Both can be true at once, and that's where the real pressure starts. What would weaken this setup in the near term? A decisive loss of the breakout shelf around $90 that doesn't recover, paired with cooling urgency signals. A sustained dollar rebound combined with tightening financial conditions that drains speculative appetite. A clear risk on rotation that pulls safe haven flows away. Or evidence that the demand pulse was transient and not anchored by procurement or structural tightness. You don't need to fear those possibilities. You just need to know they exist so you don't narrate yourself into a corner. And what would confirm the setup? The market holding higher lows, keeping bids under $90, showing resilience after dips, and continuing to reflect urgency in near-term pricing. Add in continued macro stress, tariff chatter, geopolitical uncertainty, inflation pulses, and you've got the kind of environment where silver doesn't just drift, it hunts. Here is the final mental reframe I want you to keep. Most people stare at the spot price and ask, is this too high? The better question is, what is the market forcing participants to do right now? Because in a breakout moment, the winners are the people who understand forced behavior. When spreads stress, someone must pay up. When options positioning flips, someone must hedge. When margin expands, someone must sell or post cash. When procurement timelines compress, someone must buy regardless of sentiment. That's the hidden engine behind the drama. If you're still here, you're probably not the kind of person who needs to be told silver is volatile. You already know, the real edge is staying rational while the tape tries to make you emotional. That's what separates an investor from an audience member. So keep your two scenarios, keep your levels, keep your invalidation, keep your checklist. And when the market whips around, remember, volatility is often the price of admission for the kind of move that rewrites consensus. And if you stick to rebuilding a community of people who doesn't outsource their thinking to headlines, people who actually track structure, incentives, and what the market is forcing, stick around because the next couple of weeks are going to offer a masterclass in how paper and physical stop pretending they are the same thing once time gets scarce.